Alrighty, folks. While I was in Alaska, a channel that goes by Robuilt interviewed Ryan Pineda. And the title of the video is Why the Buy One Rental a Year Strategy is Dead. And this clearly got my audience excited because I received no less than 10 texts and 30 direct messages saying, Zuber, you've got to watch this. So we've got Jason Hartman here to talk about it. Jason, I'm going to play about 10 seconds from this, hopefully into the microphone, just to get your thoughts. You ready?
Sounds good.
All right, let's go.
As you can probably tell, he's pretty fired up because he believes that 99% of new investors are starting completely backward. They're playing the slow game, saving up for one rental a year, hoping to maybe build wealth in 20 or 30 years.
Well, instead of listening to all of that, I just want to hear from you, Jason. Do you think the buy one rental a year strategy is dead? Do you think it's not a way that people can get rich over time?
Of course, I don't think it's dead. Compared to what? Compared to doing nothing, putting your money in the stock market? I just don't even know why anybody would say that. It doesn't make any sense.
Well, they would likely say it because they're selling you something else. Is my sneaky suspicion. They want you to believe in their Airbnb arbitrage or they're wholesaling this or that. And so I did listen to it again. There's not usually a video on YouTube where my audience reacts so almost violently. Mm-hmm. And this one was one of them because they were basically saying one rental at a time is dead, which obviously is a personal attack. And while I don't think Ryan ever got there, it was definitely kind of leaning that direction. And when I watched it, I was like, do you guys really think everybody's an entrepreneur? Like Ryan Pineda is an entrepreneur through.
Versus go start a company. Right.
That's easier.
Okay. Yeah, that's a lot easier.
And that's what drives me crazy. I heard Ed Millett talk one time, and he's like, only 9% of us, meaning the adult population, are wired to be entrepreneurs, and more than half of those fail. Yeah. So how I translate that is 91% of us are employees. So that's certainly who I am.
Let's get this super clear right now. I've been an entrepreneur basically all my life. I've never had a real job. Okay. And I'll tell you something, the difference in terms of the amount of effort, skill, luck, ambition, willingness to just put up with massive amounts of bullshit is dramatically different being an entrepreneur versus being an investor. Being an entrepreneur is like all of those problems to, the 10th power. It's just, being an entrepreneur is like, you've got to have a very thick skin and you've got to be able to put up with a lot of discouragement and headwinds and people cheating you and
suing you and doing all.
It's just, that's just a whole nother level of, it's not even a comparison,
And that's where I went with this. I'm like, are you guys really trying to tell me that it is better to be an entrepreneur than live below your means, stack cash, buy assets one a year, and then over a decade you've got 10 assets, and oh, by the way, you're probably going to be rich soon.
Yeah, right.
That's just it's mind-boggling. Like back to your compared to what? I would not even compare those things.
Those aren't even in the same ballpark.
Yeah. So again, one rental at a time is not dead, right, Jason? I just got to have.
Most definitely not. Look. It depends how ambitious someone is, of course, right? Buying 10 rentals is going to make you nice and comfortable. You're going to have a nice retirement on that. You may become literally wealthy from that, but having a business, you can either totally fail, crash, and burn, or if you get lucky and you raise money and you hit the timing right and you stay out of trouble, you might hit a home run. Okay, so it's the difference between sort of a very reliable, sure thing, which is the investing, versus taking a giant risk that may well pay off. There's lots of business successes, but what you don't see in business is you don't really see all of the failures. You only pay attention to the successes. And as humans, our minds are very bad at quantifying and understanding what doesn't happen. We see what does happen pretty well, right? But we don't see what doesn't happen. And what doesn't happen a lot of times is more profound than what does happen. Okay, and I'm not saying the failures don't happen. Of course they happen, but we don't really see them, right? There's no show or media outlet that really says, here's all the businesses that failed today. Nobody wants to admit that, right? So
it's funny when I think about this. And again, I've been trying to help people get wealthy for now 8 years since I retired. Yeah. And I hear this quote. I don't know if it's sourced anywhere. It's been repeated enough where maybe it's true, maybe it's not. But 90% of millionaires did it with real estate, but 100% of billionaires did it with private equity. And how I translate that is real estate is the slow, steady, but for sure way of doing it for most of us. But the upside of hitting it big with a business is 100x. And I have no problem saying that.
Yeah, no, I agree. I mean, look, it's just not really a comparison. And the interesting thing is I've noticed, like in my collective mastermind that I run, every wealthy person is a real estate investor. I mean, Taylor Swift, Mark Zuckerberg, they're all real estate investors. Like, you cannot avoid real estate if you're going to get wealthy. I mean, you just have to be a part of it. It's like a 99.9999999% of wealthy people are real estate investors. Okay, there's just no exception to that.
Yeah, Elon Musk might be the exception. He sold all his real estate recently.
Yeah, but he was an investor.
He was, yes.
And I bet he's back in the game now,
He could be. He could be, yeah. So I had a lot of people hit me up. I watched the video and I'm like, so we're trying to tell people to quit their job and start a business, as opposed to save your money, buy a cash flowing asset and wait 10 years. Yeah. I'm like, who's benefiting?
You don't have to wait 10 years though, Michael. It doesn't take that long most of the time, It mostly happens faster than that. It doesn't happen in 2 years, but it does happen faster than 10, I would say.
No, I agree with that. And I've often told people that you just got to get through the first 5 years. You got to get the compounding. You got to let it grow and you got to learn your lessons. But the 5-year mark is really where, for most people, you can start to see it. Yeah. Right. In the first couple of years, it's like, is this really working? I'm not sure.
Yeah, but right. A lot of times in real estate, you don't feel like it's working. And it's back to that iceberg metaphor that I talk about, right? The iceberg, most of it is below the surface of the water. The thing you see with your real estate is appreciation and cash flow, but there's a lot of wealth creators that are contributing to your return on investment that are below the surface of the water. That's the biggest part. Inflation-induced debt destruction, mortgage pay down, tax benefits, the power of leverage amplifying your return. Most of the real estate benefits are not apparent to us until we well, and then we kind of add it all up. And that's why it's so important as real estate investors to learn how to do the math and really understand if you're winning or losing. I can't tell you the number of times in my career helping people get wealthy like yours, people think they're losing when they're really winning. They just don't know how to do the math. And it's really important. I mean, look, if you're going to start a business, right, you're going to hire an accountant or at least a bookkeeper, or you're going to learn how to do that yourself. You're going to learn how to manage inventory, manage cash flow, and all sorts of contingencies. The real estate math is much easier. You can just learn that pretty simply, and you just got to learn how to do the math so you really know if you're winning or losing.
Well, let's talk about today, right? Obviously, today we had some pretty terrible affordability, worst since 1982. Yeah. I'm just curious what you're seeing today. I think it's a buyer's market in most of the country, but what are you seeing today?
Yeah, I don't think it's a buyer's market really in most of the country, but I think about a third of the country, maybe it's kind of what we might call a buyer's market. The affordability is terrible, but the institutions, the institutional investors know this, and they are taking advantage of that because, they are just building these huge real estate portfolios because they know that there's going to be more and more need to rent because people can't afford to buy. And that's the big play. That's the long play. And that's the one everybody should be putting their money on because housing is just structurally, pardon the pun, in short supply. And that's what we have overall. Don't let the little distractions of this thing and that thing and this report and that report, don't let it scare you. Keep your eye on the ball. Keep your eye on the big picture. That's the important thing as an investor.
Well, I'm curious if, I don't know if you saw this report from NAR. I think it came out on Friday, maybe Saturday, kind of talking about 6% 30-year mortgage rates being a breaking point. In the article, they highlighted that they thought that might unlock 5.5 million households. Of that, they thought 10% would be buyers in the next year or so. Have you looked out and said, 6% is a magic number? Do you think it's 5.5? What
Yeah,
unlocks all these buyers?
I think 5.5 is the magic number for unlocking some inventory where people will start to sell, and certainly a lot of buyers moving into the market, right? I mean, look, the lower it goes, the more affordable it gets. No matter what, we can split hairs over 6% or 5.5. I don't know. It's all just a matter of degree. And, we'll certainly see millions more people who can qualify for the median price home if those rates go down. But remember, as investors, we don't need to have that happen. If it doesn't happen, if rates stay high and we have more higher for longer, which, we're on a downward slope, but maybe they don't come down much, right? And, the Fed does not directly influence the mortgage rate. We all know that. So, maybe we see rates come down some, but all that means is that rents just have more and more upward pressure. And don't be fooled at the little point in time that we're in, okay? What happened here, we would normally have seen much higher rents by now with these persistently high mortgage rates if we did not have a record number of new apartment deliveries in the last couple of years. So those have artificially softened the renter market, or the rental market, meaning rents are lower than they would otherwise be, okay? Because of all these new apartment deliveries. Granted, Michael, a lot of those people probably wanted to live in a single family home and rent a single family home, but the apartments were just making such good deals and offering so many incentives to bring renters in that they've stolen some of that demand from the would-be single-family home market, and that has softened rents. But
one of the things you said,
and by the way, when I say softened, rents are not down; they're just kind of bumping around, level, right?
Yeah. One of the things you said there that I think is important that I want to go back to is, it sounded like you said, and I agree, that 6% unlocks buyers, 5.5 unlocks sellers. And I think that's an important caveat, because I think the demand side of this has been constrained, and it lets go first before that, interest rate lock-in or whatever you want to call it unlocks. Because I do think you have to get to 5.5 or lower to really get these sideline sellers to re-engage in the market. I think demand comes back first.
Yeah, that's, I agree with you. Demand does come back first, because as soon as you see lower monthly payments, people just will enter the market. I mean, there's so much pent-up demand. The last few years, we've had a deficit of buyers of about 2 million per year, maybe a little less than that. So, that's like 6 million buyers that have been waiting on the sidelines that would have otherwise purchased. And they're going to come into the market first because they've been waiting.
Right.
And then you're going to see a whole nother layer of sort of non-buyers, like the people that are new buyers rather than buyers that have been forced to wait.
No, I agree. This is just the cycle we're in. We've been constraining demand because of affordability. It is getting better. Wages are going up in real and nominal terms. And if we do get to that, 6%, 5.99, I think demand comes back first. But really, in order to get a healthy housing market, we have to have what's called the move-up buyer re-engage. And, that's how you go from 4 million sales to 6 million, is because they're a buyer and a seller.
Yeah.
I still think we got a lot of time before those re-engage in any great numbers.
Yeah. And, it's what you alluded to before, and you mentioned it 2 weeks ago when we were on. It's an issue of the deal being good enough for the existing homeowner to want to sell. And right now, that delta between current mortgage rates and the rate they have is just too big. And as rates come down, that delta gets smaller. It's still there, but it's easier to swallow. And so then a lot of those move-up buyers happen.
Yeah, I've done some math with family and friends, and even today, rates are down at 6.5. A couple of friends who are, got into their first home and are there longer than they thought. Like the upgrade, which means one extra bedroom, a little closer to the nicer part of town, right? Nothing crazy. It's a double. And they're like, Mike, we can't afford a double. So they're just going to stay put until that gap collapses some, because it's worth something. It's just not worth double.
Right. No. When you say double, you mean double the payment.
Correct.
Right.
Payment. Yes. Yeah.
Yeah. So
it's all payment based.
It's a very interesting time. And, the other issue is, Americans have a record amount of home equity now. Don't quote me on the number, but I think it's around $34 trillion.
Trillion with a T.
Yeah, with a T. That's the highest it's ever been in history.
Ever been. Yes.
Yeah.
Yes.
And so people want to unlock that equity. And the other thing that we're going to see is we're going to see more innovative ways to unlock that equity. There's one way that's really interesting. I've been following it for a couple of years, and I actually started a company to do this. It's called HEI, or Home Equity Investment. And I'm surprised you're nodding. You're not familiar with this. Let me tell you.
No, I'm not. Yes, please.
This is a really interesting new financial product. It's not that new, actually, sorry, but it's becoming known, this financial product. HEI, Home Equity Investment, or HEA, Home Equity Agreement. It's referred to both ways, mostly HEI. And what it is it's a way for people to unlock equity in their home and not give up their cheap mortgage that they already have. So we're all familiar with the lock-in effect. This is why people don't want to sell, because they've got an ultra cheap mortgage that they don't want to give up. And you can't blame them. I wouldn't want to give it up either, right? And so what this allows people to do is basically sell an option for part of their equity for cash now with no payments.
Oh, okay.
Yeah, it's not a HELOC. Okay. Basically, what they're doing is they're taking on, if you will, a partner. Okay. Right. And they're saying, okay, I own this home. My home is worth $600,000 and my mortgage balance is $200,000. And, I'd really like to tap some equity to do a remodel or add a bedroom or buy another rental property or whatever. They can use the money for anything they want, right? They could add solar, they could do whatever. Okay. So here's a way to basically sell an option. It's usually an option. Okay. It might be a forward sales contract. There's two basic ways they do it. And usually it's an option though. They sell an option for part of their equity. So they could have $100,000 today to sell, 20% share, right? Then when there's a liquidity event years later, whether it be a refinance or they just want to buy out the home equity partner or they sell the property, then they have to share some of that equity. But remember, no payments.
Right.
They didn't make any payments. It doesn't increase their debt to income ratio. It's not debt. Okay. It's just a sale.
It's an equity partner. Yeah.
Yes.
You're giving a little sliver. Okay.
Yeah.
Wow. Yeah. That's, I do agree. That's coming.
This is going to be a big product. You're going to be hearing about a lot of offers on this in the coming years.
Oh, for sure.
It's a little cottage industry now. It has actually been around for a while. Some of the companies doing it have been doing it for, many years, but nobody heard of it because it just hasn't been a thing.
I hadn't heard of it.
Yeah, well, and one of the problems with this industry is that the capital that would be the investor, right? The capital markets that would fund the deals, that has to be very patient capital. And that's unusual that capital is not usually like that. They want an instant return on investment. If the capital puts its money into a mortgage or a HELOC product or anything like that, it immediately gets monthly payments.
Correct.
On this, there's no payments. So it's a different kind of capital.
Yeah. That's really interesting. And I agree with you. It's funny. I had a conversation with Pace Morby 5 years ago, and I said, dude, sub 2 is going to come into the prime and you're going to kill it. Yeah. I would tell you today, having heard this conversation, never knowing about this product, is you're about to have 2, 3, 4 years of just the wind at your back, because again, there's trillions of dollars out there with 2s and 3s and 4 mortgages, god awful amount of equity. And I think a lot of people are going to look at this, go, okay, great, no payments, that doesn't hurt. I give up, something in a decade. They're going to be like, it's free money anyway. So this is going to become very, very common. What is it called again?
HEI, or Home Equity Investment.
Very cool. Folks,
and there's just a few players out there now, not many. When I started looking at this a couple of years ago, Michael, I looked at some of the companies and what they were charging and so forth. And I thought, I got to get into this business and start my own company doing this, because if I was just a little less greedy than they are, I would do really well.
Clean up. Yeah.
I thought their fees were pretty high. I just thought their deal was kind of expensive. But again, it's a solution that is really fitting for the time we're in. It really offers people something good. They don't have to do a bunch of fancy qualifying. You don't have to submit a million documents. It's based on the asset. And they do check credit, but it's not like really important. They'll go down to pretty low credit scores and just give the money. And you know what this also tells us? Always think of it from the other party and how that other party is viewing it. So on one hand, we've got all these institutional investors like Invitation Homes and American Homes for Rent and so forth that own tens of thousands of single family homes, okay? They didn't do that before the Great Recession. Correct. And that shows us that the smart money has a lot of faith in the housing market, okay? Because they're betting on it. They're betting, zillions of dollars on it. And so that should give us faith, okay? That all of these MBAs, all of these really smart people on Wall Street, are putting a lot of money in the housing market. But HEI also shows us that another form of investor has a lot of faith in the long-term value of the housing market.
Yeah,
because
true.
They're willing to buy a portion of your house or your rental property and sit and wait patiently without getting any yield on their money. They're just going to wait for 4, 5, 7, 10, 20, 30 years. There's one company that actually goes 30 years with no payments. How patient do you have to be?
That's wild. Jason, you're amazing, man. Thanks. And again, one rental at a time is not dead, correct?
No, definitely not dead. It's very much alive.
Appreciate you. Take care.